Welcome to the Market Pulse podcast from Equifax. I'm your host, Olivia Voltaggio, Senior Content Manager for the U.S. Information Solutions business here at Equifax. Our March Market Pulse webinar really hit a chord with our audience. The topic explored the nuances of affordability and its impacts on individuals' financial situations. We had an incredible all-female panel that included Amy Kruse-Cutts, President and Chief Economist at AC Cutts and Associates, and three of my Equifax colleagues, Maria Urtubi from our Risk Advisory practice, Anna Fisher, Vice President of Specialty Finance Consulting, and Mariette de Melon, Director of Pre-Sales Analytics. They had such a great presentation that the audience wanted more time for Q&A. So our panel is back today to answer your burning questions about the economy, credit, and affordability. Amy, Maria, Anna, and Mariette, thank you for joining us again today. I'll start with you, Mariette. Are newer, lower prime vintages performing better than higher prime vintages in consumer unsecured loans?
Good afternoon, Olivia, and thank you very much for having me today. We have certainly seen a lot of changes in the consumer lending space over the last 4 years. To the question of whether the higher prime vintages are performing worse than the lower prime vintages, the short answer to that is no. From the data that we're looking at, the Vantage score is still rank ordering risk. And so we do see that lower prime vintages are doing worse than the higher prime vintages. That being said, if we go back over time, we can certainly see that recent originated vintages do have a higher risk of default than older vintages. And I think a good context to bring to that is that there has been enormous growth in the space in the last 4 years, with many new lenders stepping into this lending space, and that we have seen a slight loosening of underwriting standards over the past 4 years. As an example of that, consumers who are taking up unsecured personal loans right now have an average of a 5-point higher debt to income ratio than they did back in 2019. And so this, at least in part, explain the higher risk that we are seeing in that space.
Are we seeing revolving utilization trends start to drive higher delinquencies in the near prime credit area?
There certainly has been a pretty sharp increase in utilization in the last few months. And just a couple of months ago, utilization has now reached pre-pandemic levels. Now, that by itself may not sound like a big deal. We've just reached pre-pandemic levels of utilization. But I think the important context to provide there is that credit limits are now 26% higher than they were pre-pandemic. And so what we're saying is, yes, we're back to the same level of utilization, but off of a much higher basis credit limit. And so, yes, consumers are spending more. And we do understand that higher utilization is associated with increased risk. And we know this to be true both at the point of origination and also at the point of account management. So when a consumer has a sudden increase in their rate of utilization, then yes, their likelihood to default increases significantly. What we can say about the near prime space that the question was about specifically is that we do see a very similar trend. So yes, we are at the same utilization levels than pre-pandemic. But again, we do have a much higher credit limit also in the near prime space, and that credit limit is now 14% higher than pre-pandemic. So to recap, I do think that the increase in utilization is something to keep an eye on, but I think that when we do so, we should also look at it in combination with the consumer's actual credit limit.
Absolutely. And continuing on the theme of delinquencies, Anna, what are some additional insights you can share on delinquent loans, specifically regarding near prime and subprime credit profiles?
Thanks, Olivia, and good afternoon, good morning to everyone. Thanks for joining us today. Happy to be here. If we look specifically at the subprime space, we are seeing some leveling off in delinquency rates, but we're still about 5% higher than we were pre-pandemic. When we start looking into the near prime and subprime space, I think what's even more interesting than the delinquency trends, which are pretty visible across the board, like that's data everybody has, it's much more interesting to start looking at the consumer profiles of people in that space. Like we saw in Maria's data, it's not always the trend that you'd expect. People seeking financial services in what we'd historically consider a subprime industry area are not limited to this financially fragile 600 and lower credit score that we are used to thinking about. When we look at the data coming through our subprime channels, we see consumers with scores spanning the entire spectrum. We see 20% with credit scores that are near prime, and depending on the segment, 15 to 40% of consumers with traditional credit scores that are prime or super prime. And these are consumers seeking these more non-traditional, again, historically subprime kind of products. And maybe that's not surprising, given Amy's data, given the pricing issues, given the things that we're facing in the economy right now. Affordability is a real issue. From the end of 2023, reports are still indicating that 60% of people were living paycheck to paycheck. That's clearly more than the set of folks in this under 600 bucket. And so that's a kind of scary statistic. And within that, even close to another 20% are struggling to make payments. So how do you decipher where there's true hardship, where it's just versus just this increase in consumer spending? Mariette said it, Amy said it. We know that consumers are spending. Utilization is up, limits are up. And an interesting term that I came across recently was this concept of money dysmorphia, and the idea that there's a big disconnect between between my true financial situation, the influences I'm getting from social media and the digital Joneses, and trying to keep pace with that and just spending money. And so as we think about delinquency and we think about how to navigate this, it's important to think about how consumers are navigating it. Another report indicated that many are choosing to rely on overdraft protection, which introduces a whole new set of risk and a different kind of delinquency component for the lenders and the consumers themselves. And so trying to think about how to help consumers and really understand some of their intrinsic motivation is an interesting way to start thinking about how to stay ahead of delinquency in this space.
For sure. Amy, along the lines of rising prices and delinquency rates, this next question is for you. Some of our audience members wonder, given this environment, what it would take to slow consumer spending.
It's a great question. I think economists have been a little bit flummoxed by the strength in consumer spending. I think that part of this really was driven by the pandemic era relief payments. A lot of that went into checking our savings accounts and stayed there. I look at places, several of the largest banks have really nice research institutes and report on the balances that are in consumer checking accounts or savings accounts at those institutions. And they're still reporting that there's a little bit of gas left in the tank, although it's getting pretty close to empty. But again, it's an income level kind of thing. When you make 150,000 plus a year, it's a whole lot easier to balance that budget, even in the face of higher costs, unless you've got teenagers. But it's a lot easier to balance those costs. But if you are in a job that where you're making significantly less than that, even worse if you have variable hours, so it's very hard to manage from week to week, even what the income is that you're going to have, or you're a consultant, and it takes a while between invoices and payments, and that cash flow issue really matters. And the less money you make on average in sort of your aggregate, the more financially vulnerable you're going to be. And so we are seeing that stress much, much stronger in sort of low income, and I'll sort of say that by at the household level, not so much, one worker in a family that maybe doesn't earn as much is not what I'm talking about. I'm talking about the household level. And, I think that kind of goes back to some of these discussions we've just had about subprime and near prime credit. When somebody is in a subprime credit situation, they often get there because income flows are uneven and hard to predict. And Some people, of course, can't really manage their finances. They haven't really learned how to do that. But many of them just simply are not in a good place where they keep getting shocked month to month. So there's a lot going on there, but I think it's indicative when you say, Mariette, that newer subprime and near prime vintages are not performing as well as they did previously. When we talk about just new accounts especially are very indicative of the risk that people are seeing, because those who are seeking credit more often are in need of credit, not just shopping for the best points value. So I think that we're starting to see a chink in the armor of consumers, and Taylor Swift concerts notwithstanding, demand is starting to shift for some of the other sort of discretionary spending. Seeing a little bit of it in like the hotels and restaurants side of things. So I think it's starting already.
Speaking of consumer behavior, Maria, I know one topic we've covered on previous Market Pulses is student loans, and many of today's registrants wanted to know how student loan debt is affecting consumer behavior. Do you have any data on that yet?
Yes, federal student loan payments resumed last October, but with the on-ramp program, delinquency is not going to be reported until the end of this year. So we have yet to see the full disclosure of the impact on consumer behavior. Historically, student loans have been relegated to the bottom of the payment hierarchy, and income-driven repayment plans such as SAVE have cut back payments for some individuals all the way down to zero. And new features are still to be disclosed through this summer. So that would facilitate making these payments, but individuals are also being strategic on whether they pay or not, given things are still being disclosed. So we don't have a full picture just yet.
Yes, another registrant asked, is there a looming problem with student loan debt, or will the issue kind of fade away? And to your point, given that we don't have that full picture yet, it makes sense that we should just stay on top of our accounts and monitor them for these kinds of changes to financial situations. Which brings me to another question for you, Mariette. One of our registrants indicated a desire to learn more about how they can calibrate their models to post-pandemic consumer behavior. What are your thoughts on that?
I think that is a very, very interesting question. And we have heard from multiple customers that there is currently an observed shift in the odds associated to those scores and those models. And so the question really is, how do we handle this? What can we do to mitigate that? It definitely makes sense to review the decisioning strategies to get those that alignment between the consumer's current risk behavior into your decisioning strategy. And so in a situation where your model is no longer separating out the good and the bad as well as it previously used to, that would be a good opportunity to start bringing in more data points into that decision strategy. And that could involve looking at alternative data scores. It could involve looking at any other secondary score like a bankruptcy score. It could involve any data point that will help you better understand your customers, your consumers' current credit debt commitments and their spend capacity. And so I think it is definitely recommended and advisable at this point in time that if you are seeing that shift in odds on your current score or model that you have in use, to consider going to some deal decision strategy at this point.
Speaking of solutions, Anna, are you seeing more credit unions and financial institutions using complex algorithms, that is, models outside the traditional credit score?
I love this question because it really opens up a more philosophical debate around complexity as a whole. Is complexity always better or not? And in many cases, we see folks trying to simplify and streamline. It's really about finding a model that works for you and your business. The big hurdles to complexity are implementation and fair lending requirements. And if you can adapt to those and accommodate them, great. Then complexity may have a big role to play there. But as Mariette was just saying, what's even more interesting is getting creative with the business model. Are you layering in alternative data? Do you have multiple strategies deployed for different channels, for different product lines, as opposed to using a blanket sort of one size fits all approach? These aren't necessarily novel ideas, but it's really about when it's difficult to adapt to complexity, what are the easy levers you can pull to implement now, change now, without going through a major regulatory overhaul, without having to make major structural changes to how you're doing business. But the goal is the same. Can you get more targeted offers that are going to be more profitable and have better performance? Can you get higher conversion rates? Can you increase retention? There are more levels than just complexity and making a better single magic model that will get you there.
And following up on that, Anna, what innovative tactics can financial institutions deploy for better credit portfolio management?
Seeing customers use portfolio management as a response to the turbulence of both the less recent pandemic times and now the more current economic changes is really exciting. Again, not necessarily innovative, but certainly being adopted more and more is a change in frequency. We heard from Amy, we heard from Mariette, consumers, we ourselves are changing our own outlook on our financial standing month to month. We are making changes about how we're spending money. We are making changes about where we're looking for financing at a much more accelerated velocity than maybe historically. And if consumers are doing that, why can't lenders do it too? And we've seen cases where increasing from an annual review or a quarterly review to a more frequent, even monthly review can have an ROI of 3 to 6x, which is huge for the lender, and can provide a lot of benefits for the consumer. If you can help them stay ahead of some of these looming problems that we've been discussing today, that can really help you increase loyalty. And I think that's where people on the cutting edge of portfolio management tactics, that's where we're starting to think about things like AI, and not AI for decisioning, but AI for pattern recognition. How can you use the technology that's available to us today to anticipate consumer behavior, to think about trends, to redefine your strategy for the next 5-10 years, in addition to staying on top of your business and managing the portfolio? And that's going to be particularly useful in this current climate where we know there's higher debt exposure, there are more options for funding, and customers are seeking those. Again, we saw high utilization, et cetera. And so how can you be the phone call they make? How can you anticipate what they're looking for, offer them the products they need, come up with new products? Can you build alternatives to what's out there in the market today so that you become the trusted advisor, the trusted partner, the payment they're making? And really use your portfolio management not just as a tactical tool to manage the business and the cash flow, but also to think about your business as a whole more strategically.
Thank you, Anna. And finally, to close out on a forward-looking question, Amy, what do you feel economic trends are going to look like for the next 2 to 3 years?
So it's a great question. The challenge, of course, is that there's so many unknowns looking ahead. Sort of in the big picture, though, I anticipate that we will see a normalization of the yield curve. I'm hoping that happens without a recession, but I think that's a pretty safe bet. That means that at least relative to short-term rates, long-term rates will go back to being higher than short-term rates. And the mechanism that I anticipate this to happen is that short-term rates come down first. Excuse me. And that long-term rates will then start to follow. Markets, of course, can go very quickly. And the market right now seems to think that the Fed is very serious about inflation. Sorry, a little coughing fit here. With that said, I think that GDP, even if we do end up with a mild recession, that we'll start to get closer to back where we were pre-pandemic, that things will get once again back on trend, especially with disposable personal income, and that economically we will start to feel a little more like it's a better economy, not just the statistics showing it.
If you enjoyed today's episode, tell your friends about us and subscribe. If you'd like to send us questions or suggested topics for future episodes, email us at marketpulsepodcast@equifax.com. And don't forget to register for our Market Pulse webinar series at equifax.com/marketpulse. Our team of experts works hard to provide relevant economic and credit insights to help your business make more confident decisions and build resilience to help you focus on forward. Thanks for listening, and please join us next time.